Hi, this is Richard Odyssey. Real estate is the basis of wealth of every successful individual, and the key to rapid success in real estate investing is to choose the right deals. That is, do deals that yield a high profit and high return with low risk, and avoid deals that yield low return or have high risk. And when you know that you can win big on every deal you do, you will gain confidence and become wealthier than you ever imagined. A wealth that will bring you financial freedom to get or do whatever you want whenever you want it. So the first question is, what is the criteria for a winning deal? Here are the key elements to every great deal. First, a positive cash balance. When an investor is forced to take money out of his pocket to keep a deal afloat, that investor inevitably becomes a motivated seller and will suffer economic loss. Second is high profit. High, of course, is relative. There also must be a high return on investment. That is, the amount of money you make relative to the amount you invest and the time it takes to get it. And third is low risk. In my opinion, this is the least appreciated key to investing success. A deal should be able to withstand the worst-case scenario and leave the investor in the black. In fact, the reason most deals go bad is because of unplanned costs or over-optimistic estimates of income. If these risks had been properly considered before the sale, the terms could have been adjusted or the transaction canceled. So why do deals go bad? The first is for lack of due diligence. Failure to know what the real market value of the property is, the cost of repairs, the actual market rents in the area, financing costs, liens, and so forth. They can lead to great trouble because no amount of software or analysis can make up for bad information. The second is failure to accurately project cash flow and profit. The investor must take into account rent increases, vacancy rates, mortgage balances, inflation, construction costs, and so forth. All of these factors will change with time. Most investors lack the software to account for all the variables, so they ignore them and hope for the best. Bad idea. The third is that quantifying risks is a key to successful deals. What will happen to cash flow if the unit is vacant for 2 months out of the year? Or what will happen if repairs are 25% higher and take 6 months to complete rather than 3? These are all factors that must be accounted for, or the investor is looking for trouble. Fourth, decision-making standards. Once the information is at hand, what risk is acceptable for what amount of profit? Standards for a good deal are essential because you do need to know a good deal when you see one. Now, no deal evaluation system, software, or method is worth a dime unless you feed it accurate information. And there are 2 ingredients to success here. 1 is to make sure the information you get is accurate, and 2, to make sure you have a checklist of some sort so that you are mindful to get all the information you need. As far as point 1, my rule is never believe the seller. They always exaggerate, lie, or simply don't know and make things up. Make sure you see the paperwork, get your own title research, and make your own inspections and repair estimates. Now, just as important, you need to determine your purchase costs, repair costs, carrying or holding costs, and cash flow. Depending on your exit strategy, there may be certain information you need for this particular deal or another. For example, if you're going to hold the property, you'll need to be able to calculate your cash flow over the time that you're holding it. In addition, your income expenses, your mortgage payments, and so forth. For example, as you can see in this illustration, on the income side, you must consider the option fees, the rents on single or multiple units, and any additional income such as laundry services, parking, and so forth. On the expense side, you have administrative expenses, operating expenses, maintenance costs, taxes, and insurance. This can be rather involved, as you can see from the illustration, especially for multifamily units. By the way, these illustrations come from a piece of software I developed called the Deal Evaluation Tool. I created it to evaluate any type of real estate deal, since Michelle and I do many types of deals from short sales to lease options to multifamily. It reminds you of every relevant factor in your deal, calculates the financial status, and evaluates the strong and weak areas. I'll tell you about a special package I've put together so you can also benefit from this resource. If you can't wait, just click the link at the bottom of the screen right now. If you intend to hold onto a property for long term, that is, 2 or more years, then you need to project the future changes of the property's financial status. For example, how will rent increases affect your bottom line? How about expense inflation and tax increases, vacancy changes, the cost of vacancies, property appreciation, loan payments, the principal pay down as time goes on and your tenant pays the rent to pay down your mortgage? It's quite laborious to do all this by hand, so I created a financial projection component in the deal evaluation tool that allows me to enter all my assumptions and projects out all the financials for a period up to 10 years. By the way, I went up to only 10 years because no matter how careful one is, it's simply not possible to project beyond this point with any reliability. So once we have our information, here's how to decide deal or no deal. Go through a checklist and verify the numbers in the deal. You want to verify market value, rents, expenses, vacancy costs, repairs, purchase costs, selling costs, carrying costs, and so forth. Put all the numbers together to calculate the cash flow, the return on your investment, and profit over time. And then quantify the risks due to vacancy, repair costs, overruns, maintenance expenses, and so forth. And then compare the numbers to conservative standards that have a high probability of bringing a profitable outcome with low risk. Remember, as I mentioned earlier, that most deals fail because the investor has failed to adequately account for the risks of something going wrong. Specifically, that means to actually quantify what effect the worst-case scenarios will have on your bottom line and make sure that one is protected from the consequences. Here are some of the risks that need to be quantified. The risk of depleting your cash balance, low return for the cash invested in the deal, the maximum vacancy you can afford without getting into a negative cash flow, how much of an increase in expense can be tolerated without, again, impairing your cash flow to a negative value, and how much repair cost overrun can be supported and still make a good profit, and more. In most cases, the first proposal in a deal will not be acceptable. In fact, if it is, the investor has probably asked for too little. So the challenge is to come up with prices and terms that could make the deal a good one. In doing this, the price and terms must be adjusted so that the potential risks are reduced to acceptable levels. It sounds simple, but in reality, it's quite complex because changes in terms interact with each other. For example, if you reduce repair costs, you will need to borrow less or use less cash, which could affect your cash flow, cash-on-cash return, vacancy, and expense variance, profit, and so forth. Wow, it certainly overwhelmed me. So I built this process into the deal evaluation tool. In a minute or two, I can explore the effects on my bottom line and risks arising from multiple changes in price, terms, financing, and so forth. This provides the ultimate negotiating flexibility in reaching a mutually acceptable solution with the seller. Here's an example of where changing the rental strategy to a lease option strategy converted a negative cash flow situation into a positive cash flow outcome. We simply changed two things. One, by getting a lease option tenant buyer, I got a non-refundable option fee up front, which put money in my pocket. And two, since we regard tenant buyers as, quote, owners in training, unquote, we require them to pay for any repairs, thus reducing our maintenance costs. These two small changes, as you can see, changed the projected cash flow from a negative $706 to almost $5,000 in the positive. In this case, the strategy to switch was enough to make this a viable deal. When I started investing, there was no tool or software that would satisfy all the criteria that I've been speaking about. In fact, our inability to accurately assess our risks for Michelle and I cost us dearly, and after barely surviving some bad deals, I decided to do something about it. That's why I created the deal evaluation tool. It has all the features I wanted. One, it gives me the ability to get a quick overview of the deal with just a few bits of information from the seller. Two, it guides me on the information I need to get and verify to make my offer and buying decision. Three, it calculates everything I need to know, even complex financing like construction loans or adjustable mortgages. Four, I get a simple to understand summary of my profit, cash flow, and risk factors. Five, it identifies the risks and guides me on how to change the terms to eliminate them. And six, I can easily explore the various exit strategies and have multiple offers ready to make my deal work. And I use this tool in every deal we do now, before we make any decisions. And the days of deals losing money are over. Look, one bad deal can take you out of the game, especially if you're just starting or relatively new. For rentals and lease options, negative cash flow can quickly turn the investor into a motivated seller, and selling at a loss. For rehabbers, underestimating costs or time to complete your job can rob the profit from right out of a deal. And of course, the time and stress of extracting oneself from a bad deal should not be underestimated. And finally, there's the opportunity cost. While you're struggling with your problem deal and your resources are all tied up, you could be missing out on the ultimate profit bonanza. You know, the average investor profit on a single-family home is approximately $30,000. For multifamily dwellings, that profit could be up to $30,000 per unit or more. That's the benefit of doing good deals. So by choosing to only do good deals with a positive cash flow and low risk, let me ask, how many deals would you have to do in order to become financially independent? This strategy is the key to becoming rapidly wealthy by investing in real estate. It doesn't matter what area you choose, from rehabbing to rentals or short sales to new construction. Just do good, low-risk deals and watch your bank account explode and your stress levels decline. I developed a deal evaluation tool to help you achieve that goal. To the best of my knowledge, this is not only the most comprehensive deal evaluating software, it is also the only software designed to help the real estate investor make quick, accurate, and low-risk decisions on what deals to pursue, the ones that yield high profit with low risk. I've also designed a one-year training program to help the investor learn to use the deal evaluation tool and incorporate it into their decision-making process. In addition, as a member of the DET, the Deal Evaluation Tool Users Group, you will be eligible to attend a special members-only webinar camp, a 2-day event where you'll be trained on evaluating deals and obtaining quick and low-cost financing, growing your wealth, and more. And I've made this incredibly affordable. In fact, this is my very special offer to you and will only be available for a very limited time. I advise you to use the contact information on the screen to get your membership now before this special offer disappears. It's my gift to you as a fellow colleague. I'm looking forward to working with you. Just go ahead and click the link on this page or type the website into your browser, and best of success.